Hello everybody. Well, I guess a lot of you must be thinking, what has spooked the markets recently? Because share prices have been pretty wobbly since mid-May. The unusual thing with this is the source of the problem, which is this. The American economy looks better than people expected. There's an improvement in housing, there's improvement in new builds, the motor industry has been okay, energy is doing well. And because of all these positives, it's thought that perhaps Ben Bernanke and the Federal Reserve will chop the $85 billion a month that they've been doing in quantitative easing since December last year. Now that may seem to you bizarre, because you would be saying, surely, if the economy is doing well, if business is beginning to improve, if house prices are picking up, that's got to be good for corporate profits. And you would be absolutely right. The problem, however, is that the market tends to be very focused on interest rates at present, and there's a worry that if this quantitative easing eases back, the interest rates will begin to rise. But it's not really the equity market that should be worried. Sure, equity prices have made a big recovery in the last year, and things like PE ratios and price to book ratios are a little overstretched. But gearing's quite low, cash generation's still good, and dividend yields are generally better than bond yields. It's the bondholders that need to be very, very wary, because it's a long time since we've seen the effects of dramatically increased interest rates, as happened in the 70s, and they are devastating for bonds. For that reason, we are being very wary about holding any long-dated bonds.